Hello and welcome to Long Investor. So my last video was on May 24th and has been around 2 weeks from there. And we've seen some interesting development lately. So let's take a look at the data again and see where I think we'll be heading in the next couple of weeks. So for the past week or so, the S&P 500 and nasdaq has been pretty much flat for the whole time. And I believe it has something to do with the consolidation on the 2-year bond yield. And as I've mentioned, the 2-year yield and the Fed funds are closely related to each other. And we had a breakout on the 2-year bond yield without the Fed actually raising the rate hikes. And I have talked about this in my previous video that the Fed is late for raising the interest rates. So the market has already corrected itself, has already priced in before the Fed has actually done anything. And since tech stock is very sensitive to the Fed funds, so it has some sort of a inverted relationship with the 2-year bond yield. So as you can see, when the 2-year bond yield has been rising recently, that is what making the tech stock tank. And lately, we're seeing a consolidation on the 2-year bond yield, and that's why Nasdaq has stopped falling and actually had a little bit of rally and is now consolidating. So last time when we had the rally in March, the 2-year bond yield is also rising, so the smart money are expecting more rate hikes back then. And as you can see, after the March rally, it has fallen even lower than the previous low. And this time when we had a little rally, the 2-year bond yield seems to be consolidating. So I would say the previous rally is more of a decade bounce, and this rally we might be seeing something interesting. But it all depending on how the 2-year bond yield will play out. If the 2-year bond yield continues to go up, we will definitely see the tech stock going down again. And if the 2-year bond yield is coming back down, then it will benefit the tech stocks. We will see the tech stock going back up. And as you have known, all the rate hikes are to combat the what's so-called inflation. Now in one of my videos, I've talked about the peak of inflation for March and April, and we should be expecting to see inflation to come down. And the next CPI data is going to be released on June 10th on this Friday. But the Fed is looking at the core CPI, so it is excluding food and energy. And as I have mentioned before, the used car and new car price has been coming down, and that contributes a huge part of the core CPI. And as for consumer goods, my last video I talked about the Target and Walmart having huge inventories, and when they're doing a price cut to try to clear out the inventories, that will relieve the stress of the consumer goods price. So just those two things alone will definitely relieve some of the inflation pressure. And besides inflation, the next data to look at is the employment rate. Now having a rise of employment might seem to be good to the economy, but at the same time, the high demand for labor will push the wage higher, and higher wage will usually lead to higher inflation. So we do really want to see some sort of a slowdown on employment in order for Fresh to turn fully dovish. Now as for the demand for labor, I think it is in similar shoe as the inventories that Walmart and Target has. So before there was a labor shortage, there was a supply goods shortage. So Target and Walmart, they buy more than they can sell. So that's why they end up with a huge inventories. Same thing with labor. Since there was a labor shortage, so I think a lot of employers will hire more than they needed, as I explained in one of my videos. So the extra hiring labor is just for the rainy day. So in case they needed the labor, they will have someone on hand. But I think once the economy is stabilized and when the employers realize they don't need that many laborers, they'll start to let go of some of the labor force. And at the beginning of May, some of the tech company is hitting the brakes on hiring. And lately for Elon Musk, he's also planning to reduce the salary of some of his staffs. So we might see some more companies trying to cut their labor forces in the future, and that will relieve the rate hike pressure from the Fed. So some of the data that came out recently, one of them that we have looked at before is the insider transaction ratio. So you see in the March rally, I think a lot of them knows that it is a decade bounce, so a lot of them were selling their stocks. And since then, there are more insiders buying their stocks compared to selling. So which is a bullish sign for the market as always. And the second data to look at is the ADL line, the advanced decline line. So it is the number of stocks that's going up compared to the number of stocks that are going down on a single day. So we had a divergence between the price and the ADL recently. So this is just to say the S&P 500 was being brought down by a few big companies instead of the majority. And just 3 months ago, the media is saying the Fed will do like 8 rate hikes, 8 or 9 times rate hikes in this year. And that will put the interest rate around 3.5 to 4% by the end of the year. And just 3 months later, they might say the rate hikes might pause in September. So sometimes the news is not the best indicator for the economy or for the market. So when I'm in doubt, I don't really read the news. I'm just look at the data and try to stay cool-headed. So in the past, I've talked about the slowdown of the economy from the PMI index, that the PMI is coming down. And usually when it's coming down, it's not the time to raise interest rates, and how the Fed was late to increase the interest rates. So that is why even back then, I do not expect the Fed to raise interest rate that much. And another interesting data to look at is the Google search term for recession. Back then, no one's talked about recession that early in the year. And ever since the media is bringing up the rate hikes and, the inverted yield curve and etc., The search term for inflation went up 3 times, and the term recession peaked at around May 15th to 21st, and that is around the period right here. And as I've mentioned before, when everybody expects the same thing, that thing will usually not happen, because when you buy or sell a stock, you're exchanging with another person, so it's impossible for the majority to to be winning in stocks. So that is why it is important to not follow the news and not follow the herd, and keep your head clear, look at the data, and put in more conviction. But with that said, the 2-year bond yield will have a chance to break out. Since they were late in raising the interest rate, they might be late for reducing the interest rate also. So once again, this Friday, June 10th is the CPI data. And next week, June 14th, 15th, we will have the FOMC meetings. So next week will be very interesting to the market. And if the inflation percent drops and the FOMC meeting confirms a lower rate hike, it will definitely benefit the market. And when it rallies, I think the first resistance will be at a downtrend line. So it will be somewhere around 13.5K. And if we put the moving averages, the 200 days moving average is at the same level as the horizontal resistance over here. So if it does have a rally in the short term, and before the next FOMC meeting in July or the next CPI data, back to 30.5K or possible 14.2K. So I'll do a video update again after the FOMC meeting. So if you like the video, do subscribe to my channel and give me a thumbs up, and I'll see you guys next time.